All right, today we're going to break down a term you hear all the time, one that can sound pretty intimidating, but is absolutely crucial for any investor: market valuation.
I mean, you see this headline everywhere, right? On the news, on websites. It sounds massive, complicated, and let's be honest, a little bit scary. But what if I told you the key to understanding it all is way closer to home than you think? Seriously, think about it. You would never, ever buy a house without doing your homework, would you? You'd check the price, you'd compare it to other houses in the neighborhood, and you'd decide if it's a fair deal. Well, we're about to apply that exact same logic to the entire stock market. And that right there is the heart of market valuation. It's really just the skill of looking at the investment world like a savvy shopper and figuring out, am I looking at a bargain, a fair price, or something that's just way overhyped? So to put it simply, market valuation is just the process of figuring out what an asset is worth right here, right now. When we talk about the market's valuation, we're just talking about the collective price tag of all the companies in it. It's like one giant snapshot of the total value at this very moment. But here's the really critical part. A valuation isn't just about what's happening today. It's a forward-looking statement. It's a reflection of a collective belief, a massive combined bet on what millions of investors think is going to happen in the future. Okay, so why does any of this actually matter to you? Well, because understanding this big price tag can make a fundamental difference in your investment results. It's the difference between finding a great deal and just buying into the hype. So you basically have two scenarios. In an overvalued market, everyone's feeling great, optimism is through the roof, but your risk is higher and future returns might be lower. On the flip side, in an undervalued market, there's a lot of pessimism and fear, but that can create what investors call a margin of safety. You're essentially buying a quality asset when it's on sale, which could set you up for potentially higher returns down the road.
Now, let's get one thing straight. This is not about having a crystal ball. It's not about predicting the future. It's about setting realistic expectations and understanding the kind of environment you're walking into. Is it full of risk, or does it have a potential cushion?
So how do we actually read this big market price tag? Well, there are a few key tools, a few metrics that investors use to get a feel for whether they're looking at a bargain or a bullet they need to dodge. All right, first up, the big one, the PE ratio. The easiest way to think about it is this. If a company has a PE of 20, that means investors collectively are willing to pay $20 for every $1 that company actually earns in a year. It's a direct measure of expectation. But here's the catch. A high PE could mean investors are expecting explosive growth, or it could just be overvalued hype. A low PE might be a hidden gem, or it could be a sign that the company is in serious trouble. That's why a lot of long-term investors also look at things like the Shiller PE, which averages earnings over 10 years to smooth things out and get a clearer signal. Context, you see, is everything. Okay, next up is the price-to-book ratio. This one's a little different. It's all about the actual stuff a company owns. It compares the market price to the company's net asset value. You know, what would be left if they sold off everything and paid all their debts? It's really handy for businesses that own a lot of physical things, like banks or manufacturing plants. And then we have dividend yield. Now, this isn't a pure valuation tool, but it's a really useful clue. A high, steady yield can sometimes suggest a stock is a pretty good value. But you have to be careful. If you see a sudden spike in the yield, that could actually be a red flag, because it might mean the stock price has just tanked. Look, if you remember one thing about these numbers, make it this. No single metric is a magic bullet. These are tools in a toolbox, and they are meant for critical thinking. You have to use them together, look at the industry, and consider the economy to get the real story. Because here's the thing, valuation isn't just some number you calculate once and you're done. It's a living, breathing thing that's constantly changing based on what's happening out there in the world. You know, at the end of the day, markets are all about people. They're driven by psychology and they move in cycles. A bull market kicks off with optimism, which can swell into full-blown euphoria at the peak, pushing valuations crazy high. Then, inevitably, fear takes over, and valuations get squeezed in a bear market. And that moment of deep pessimism at the bottom, the trough, that's often where the biggest opportunities are hiding. And it's not just about feelings, right? Hard economic data has a huge impact. Things like interest rates. When they go up, a company's future profits are suddenly worth less today, which can pull valuations down. Or inflation, which eats away at everyone's buying power. A change in any of these big factors can shift the entire market's price tag. So, where does all this leave us? What are you supposed to do with all this information? Well, the goal isn't to become a fortune teller. It's to shift your entire mindset from predicting what's next to positioning yourself intelligently for whatever comes. It really boils down to a pretty straightforward approach. First, just understand the environment. Are you shopping in a discount store or a luxury boutique right now? Second, no matter what, focus on quality. Third, diversify, always. And finally, make sure every single decision you make lines up with your own personal comfort level with risk.
And this quote just nails it. It's not about trying to time the market perfectly. That's a fool's game. It's about making smarter, more intelligent decisions about when you buy and what you buy based on what's actually happening. The goal is to be a thoughtful investor, not a psychic.
All right, so let's wrap this up. What are the big takeaways? 1, valuation is just the price tag of an investment. 2, understanding it helps you manage risk and set realistic expectations. 3, use metrics like PEN and PB as tools for thinking, not as magic answers. And 4, always consider the bigger economic picture you're in. And that brings us full circle, right back to where we started. For many of us, our investment portfolio is our biggest asset, right after our home. You'd spend weeks, maybe months, researching a house before you bought it. So the final question is pretty simple. Why wouldn't you give your portfolio that same level of care and attention?